TV's gotten thinner and he's gotten fatter. And what I love about cartoons is the way they think. It's clearly the same guy, but it's not just the same guy. He's wearing exactly the same clothes. Not the same clothes that look like it. That's the same shirt. Look, he's grown out of it, but he still wears his belly's hanging out. I guess it was funnier to me than it was really funny when I put it up there in practice. Every family has one weird relative. If you don't know who it is, then it's probably you. Yeah. That's kind of scary. Somebody said, it's a mom, young mom, talking to her son outside in chairs. She said, "You think I'm a bad mom, Jimmy?" He says, "My name is Jack." Not a good start on a conversation. Okay, we were working on what's excluded from QBI, and this is, we already said, any forming services, I talked about that. Guaranteed payments. Now, what is a guarantee? A guaranteed payment paid by partnership to a partner, that's under Section 707C of the code, is deducted by the partnership and reduces QBI, and the recipient partner picks it up as income, such as SE tax, but it's not QBI. Guaranteed payments are not QBI. So what is a guaranteed payment? As opposed to what? As opposed to a draw, or as opposed to an operating distribution. You're getting the money out as a partner. It's how you're getting it out, or how it's classified. And if it's classified as a draw or a operating distribution, partnership doesn't get a deduction for that. No, the partner doesn't pick that up as income either. It just goes against their basis and their partnership interest, right? And runs that down. But if it's a guaranteed payment, it's deducted by the partnership and including the income of the share of the partner, and it doesn't qualify for QBI treatment. What's a guaranteed payment?
It too hard.
No, it's
because
not.
the K1 would show the partnership income and the guaranteed payments on the K1, and so you would add them together.
It's not real well.
That is, they are complicated.
Authority on a lot of case laws, but fundamentally, it's any payment to a partner that is paid regardless of their share of tax of income of the partnership. If it's unrelated to their share of the income of the partnership. If I'm going to get $10,000,
so it's going to be on there.
For the next 12 months, like get $120,000.
Line 1 and 5 or something of the K1, and that's where you're going to pick it up
from. If there's not going to be any adjustment of it, at the end of the year, I look at my share of the income generated by the partnership, and my share is not $120,000, it's less, and there's no adjustment. That's a guaranteed payment. It's a payment you're guaranteed to get, no matter what your income is, your share of the income. And a lot of partners, that's what they want. You know why? Because they're working for the partnership. They're providing services. And they want to be compensated for those services beyond their partnership interest. And so they say, I expect $10,000 a month, and I'm going to keep that $10,000 at the end of the year, $120,000. If that's the arrangement, that's a guaranteed payment. And you don't have any option. It's deductible by the partnership. It's not going to be QBI to the recipient. Now, how could you make it not a guaranteed payment? You may have to do something they're not going to want to do, and that is, okay, at the end of the year, I'll take my $10,000 a year draw, but at the end of the year, we're going to look at the financials, and we're going to look at my share of the income of the partnership, and if my share of the income is not $120,000, I'm going to have to pay back the excess, or credit next year's draw. Some form or fashion, what I get to keep is contingent on my share.
He's overthinking this.
Is there some
or either he thinks we're all stupid.
Contingency on your ability to keep what you're taking out based on your share?
Yeah, I mean, most people don't die in farmers by their first year.
So,
yeah, that's
how do
right.
you keep something from being a guaranteed payment?
Well,
number one, don't
years.
call it a guarantee. That's the first thing not to do. You know, a lot of partnership agreements do call it guaranteed payments because historically it hadn't made much difference from a tax standpoint, whether there's guaranteed payment or not. It's a guaranteed payment, you pay SE tax. It's not a guaranteed payment, your share of the income is subject to SE tax. But don't call it a guaranteed payment, and then have some legitimate contingency on that draw, what you're taking out, being contingent, the ability to ultimately keep it on your share of the income generated by the partnership. What if it doesn't generate any income? Then you couldn't keep any of it. Well, a lot of people are going to want to do that. And that's okay, they don't have to, but they're not going to get QBI if it's a guaranteed payment. That's the main distinction. That is the distinction. Page 5, yes. Is there a question? I'm just hearing things. Page 536. Now let's talk about what we went through. You're assuming we have a qualified business and what constitutes a qualified trader business income, what we carved out. What is a qualified trader business? It's pretty broadly defined. The meaning of a qualified trader business is any Section 162, that's of the Internal Revenue Code. Any 162 trade or business other than the trade or business of performing services as an employee, either you're stipulated as an employee or you're deemed to be a common law employee. Your SSTB, if your business is an SSTB, but that's not a qualified trade or business, but it does qualify if you're under 315, right? 157.5 on the single. And guaranteed payments, we didn't put it in there, but guaranteed payments are not trade or business income. What is a trade or business? Now, to be qualified business income, you've got to be first and foremost a trade or business. The term trade or business has always been used for 90 years, 100 years in the Internal Revenue Code, throughout the code and the regs. There was one Supreme Court case that came out years ago, and I guess there was an issue about trade or business. And in the case, I haven't confirmed this, but the judge said, and I guess his clerk counted them back before there were computers, you probably manually counted them. They said the term trade or business is used over 800 times in the code and the regs. It's nowhere defined. It's described periodically, but it's nowhere defined. So, in most cases, the vast majority of cases, you know whether it's a trade or business. You're trying to make a profit, as opposed to a hobby. A hobby would not be a trade or business. It's deemed to be under the hobby law. But if you're trying to make profit, you're generally trying to make a profit, whether it's services or inventory or a combination of the two. Even if you're losing, but you're really legitimately trying, that's a trade or business. Where does the issue come out? Where's the issue in the context of qualified trade or business, qualified business income? What type of operation is the issue being raised? And that's real estate rentals. Real estate rentals is where all the focus is, and not because they carve out real estate rentals. They say, "Oh, that's not qualified business income." The reason they may be carved out is they may not be a trade or business. If the rental real estate is ultimately determined to be a trade or business, it qualifies. The question is it a trade or business, as opposed to what? As opposed to being an investment in real estate. Investments don't qualify. Where's the dividing line? Not a clear one. And so the whole issue that the IRS, everybody's asking the IRS, everybody's asking Treasury to give clarification on this. When and if a commercial, residential rental, when is it a trade or business? And when is it not a trade? And if it is, we get it. If it's not, we don't. The IRS has not given us guidance yet beyond this generic 162 trade or business. It has been rumored, actually more than rumored. I spoke in Baltimore about 3 weeks ago, and I speak there every year, and there was one of the CPAs raised her hand this morning. She was at recently, I think it was the AICPA conference, where they had some big IRS, high-level IRS people discussing on a panel, and one of the participants asked, "Are you going to give us any guidance in the final regs on whether, when, and to what extent real estate rental is a trade or business?" And he said, "Yes." I said, "Did you hear him say," this IRS person, I said, "Did you hear him say that?" She said, "I did hear him say it." And then a couple others asked him again. And he said, "Yes," again. That's just hearsay. And use that as evidence in the court of law. But apparently, we're hoping the final regs will give us something. Or at the time they release the final regs, they'll issue a separate set of another proposed regs giving us information on whether or not rental real estate qualifies as a trade or business. I can't guarantee it. I don't know. I can tell you this, and I'm looking on page 536, item 2, 162 trade or business, and we have a cite in there right above practice alert to a Journal of Taxation article written in 2013 by Todd Keeter. And that whole article, well written, well researched, highly regarded tax attorney out of, I think, Dallas. And his analysis, it was back when we were looking at a 3.8% net investment income tax. And there was an issue in there whether, in context, whether rental real estate is a trade or business. And he wrote an article on that. And his conclusion, it's just one person's conclusion, but looking at all the case law, his conclusion was, in most cases, the courts have leaned toward, yes, it is a trade or business. The big exception, he says, is a triple net lease. A triple net lease may not, but his sense was that in most cases it would. I tend to agree with that. Now, having said all that, we now have this publication 535, proposed, draft, and they have in it determining your qualified trades or businesses. And then they have 2 paragraphs in there, and this is just the publication, it could change, describing a trade or business. and it doesn't shed too much light, but I blew this up. I blew that up and it's here. You don't have it. It says, generally, first paragraph, in general, to be engaged in the trade or business, you must be involved in the activity with continuity and regularity, and your primary purpose for engaging in the activity must be income or profit. Yada, yada, yada. We've heard that 1,000 times, dozen times. That doesn't move the ball down. Then the next paragraph. If you, and this is in publication draft 535, if you own an interest in a pass-through entity, the trade or business determination is made at the entity level. Oh, now we're starting to get somewhere. So I don't have to look at the owner of the pass-through entity, what they're doing. I look at the pass-through entity itself. So if it's rental property, and if in the entity level it's deemed to be a trade or business, even if I've got a passive owner, completely passive owner, at the entity level, the rental real estate rises to the level of the trade or business at the entity level, it will count toward the owner. So then we get to the coup de grace, which is not much of a coup, not much of a grace. This is the third paragraph. The ownership of, this is all they say, the ownership of rental and rental of real property does not, as a matter of law, constitute a trade or business. So it's not automatically a trade. And the issue is ultimately one of fact. Oh, that helps a lot. In which the scope of your activities in connection with a property must be so extensive to give rise to the statute of a trade or business. That's clear as a bell. But they are suggesting there has to be some level of activities by the owner. However, the rental or licensing of property to a commonly controlled trade or business is considered a trade or business itself. Let me pause it.
Yay. If we were Tanner and all those gamer kids, we'd be done.
And I'm not a gamer, as you can tell.
Oh, I think you're doing just fine.
Oops.
Operating business will be a trade or business. That's in the proposed regs, and they confirmed that again in the publication. That's the good news. The bad news is, if you've got a self-rental to an SSTB, there's another rule. If you've got a self-rental to doctors, lawyers, CPAs, that self-rental is a trade or business. It's also deemed to be part of the SSTB.
See, I think it's a trade or business when they're just like, they have one rental and they're renting to
And that's
themselves.
not so good unless you're under 315. You're fine with that.
Your daddy's was.
So, that's what
Yeah.
you're referring to here.
Vivian's
But back to the generic, you're leasing to outsiders.
Ben Thomas is, even though he's an attorney, he's got
the
side
50 rental properties,
must be so extensive as to give rise to the statute of trade with. It
Yeah.
really doesn't
See, I
give us
think
much
that
meat. What do they mean? What scope are they? Are obviously
when you really go into it
that
to
there
make
has
a
to be
profit,
some
this is
level
Yeah.
of activity by
then
the
it becomes a
owner.
trade business.
Now,
You just gotta,
you read the prior paragraph and it says
Most
you
house
determine
on
that
the
at
side.
the entity level. When I say owner, I mean who legally owns it. So if it's an LLC that owns it, the LLC is the landlord. The LLC is the lessor. Does the LLC have some responsibilities as landlord? They pay property tax. Do they maybe maintenance, maybe upkeep, maybe the more obligations they have in maintaining that property, the more likely it's going to be a trade or business. The less they have, the more it looks more like a net triple net lease. At least at this juncture, it appears.
so maybe that's what you look at,
Yeah,
is the
triple
lease.
net.
That's about the best we can do. But the key is, let's say I've got, and this is my position, let's say I've got commercial rental, and I got an LLC that owns it, I got passive investors, and the LLC rental, under the rental agreement, has responsibilities, but they hire a management company to manage the building. Well, that management company is their agent. When you hire a management company, for tax purposes, generally, that's their agent, so the activities and the responsibilities of the management company, you just contracted that out. That should still be attributed to the landlord, the owner. They don't have to do it, they have to have a responsibility for it. And I think that would qualify, that should qualify.
And I don't
even if
think
it's done
that
by management
beach house
companies
is
hired to
qualified.
provide those services. Is
Because
there a question?
it's not
Yes.
used.
Yeah, the question is, what about a real estate
Unless,
professional under
yeah,
unless it's never used by an
C7?
owner.
Right.
And this
You
is
know
a
what I
common
mean? But
question.
if
How
it's
do
your
the
real,
469
if it's your
passive real
beach
estate
property
rules
and you rent it once in a
interplay
while so you
with
can
one
write it
another?
off, then
Technically, they're totally
that's not a
separate.
trade
decisions.
business.
One does not control the other. They make that clear, both in the proposed regs and they make it clear in the publication. So whatever you've done or whatever the classification is for 469 is technically irrelevant. to what you're what it is under 199A technically. But if you're a qualified real estate professional, you don't rent properties. Well, first you have to be spending more than 50% of your time in real estate activities, and secondly, you have to spend more than 750 hours.
50%.
Let's assume that work has to do with your rental properties. Well, that would be a good indication that you've got activities and responsibilities on that rental property. But you could be a qualified real estate professional and do nothing for your rental properties. You could be a builder, right? You could the real estate activities that can be construction, real estate development, real estate investment, and you have on the side for 469 purposes, you got some rental properties, but you don't do anything. That's possible, and all your hours go to the real estate construction company. Well, that's not going to help you. But if you're a qualified real estate professional at 469 and those hours are coming from your activities on your rental properties, I think that's a strong sign, probably, that you're managing the property. And then that should help you rise the level of the trade of business. Doesn't dictate it, but it should help. Okay, page 537. Is there a question? No. Page 537. Item H. Now we got to recalibrate what we're thinking. Now we're dealing with a scenario. We have qualified business income, and we're dealing with a taxpayer who is subject to the 50% of W-2 wage limit. What does that mean? What kind of taxpayer would be that? An individual on a joint return that has taxable income in excess of $415,000. They're totally subject to 50% W-2 wage limit. If they're under $315,000, they're not subject to it at all. If it's non-joint, then it's 157 through 2075. What if I'm between 315 and 415? Then as I go up that $100,000 ladder, I start phasing into the W-2 wage limit pro rata. It's a formula. Software will do it. But once you get to 415, you're totally subject to it. But let's look at that for just a moment. So we're talking about 20% of QBI not to exceed this part of the limitation. The greater of two potential limitations, 50% of W-2 wages, or alternatively, if you don't have enough W-2 wages to absorb it, the sum of 25% of W-2 wages plus 2.5% of unadjusted basis immediately after acquisition of qualified property. That's basically depreciable property, tangible depreciable property. I'm going to talk about that more tomorrow. But let's assume we're dealing with, we have no issue here, we don't have any of this kind of property, so we're dealing solely with a 50% W-2 wage limit. What W-2 wages qualify if you're subject to the limit? Now remember, 315, you don't care about any of this, do you? You just throw that out.
And I know that our package will calculate it
on
the tax return, but when we're doing the rejection, that's what
it's
we
any way
can do
the 50% limit that are subject to withholding, income tax withholding, including plus elective deferrals. So your 401k elective deferral, your 403b elective deferral would be included in that. And somebody just asked me this is great. It's a little convoluted. What W-2 wage do I use? Well, from a calendar year, as a corporation or partnership, I'm going to use my W-2 wages for that calendar year. What if I'm a fiscal year? The question that the person was asking me, he had a 930 year in S corporation. So the fiscal year just ended September 30th, 2018. Haven't we already learned that entire fiscal year operation is going to flow out to 2018 and they're going to get it? But he's got to determine the W-2 wages for that QBI on that fiscal year.
He didn't say the wages my company paid.
He uses the calendar year, W-2 wages for the calendar year that ends within that fiscal year. So if we're dealing with a 930 1120S, what calendar year ended within it? Calendar year 2017. He's going to use 2017 calendar year W-2 wages. Now the good news is that's easier to compute than you have to piecemeal 2 years together. And that's why they do it. So we're
their
using
wages, not the
He's going to be using the 2017 W-2 wages.
We've been doing it just the
The end the fiscal year of the S corporation ending in September 30th, 2018, and those numbers are going to go out to the 2018 calendar year for the taxpayer. The W-2 wage limit will be based on the 2017 time. There's a requirement to count any W-2 wages. You have to have filed the W-2s with the Social Security Administration. You can file them late, but not too late. You got to file them within 60 days of their due date, or they don't count at all. There are 3 methods for picking up W-2 wages. These are safe harbors. You can use the easiest is the unmodified box method. You take the lesser of box 1 and box 5, the lesser. Now the problem there, box 1 doesn't have elective deferrals in it, although they count normally. But if you're using the safe harbor, box 5 does have elective. But it's a
Box
lesser.
one has your health
Most times
insurance.
that would be box 1.
It said that.
You're not going to get elective deferrals. You may not need them, but if you use modified box method 1, you're going to probably not get that elective deferral. Modified box 1 method. This is the second safe harbor. You can read it, but the way it's computed is you would get
This
elective
amount's
deferral.
not subject to withholding, so that would be the health insurance.
You can look
Okay.
those at your own leisure. I was going to make one other point. Oh, make this. I keep getting this question. For the 50% test, any W-2 wage paid to anybody qualifies goes into that W-2 wage amount. Does that have to be just W-2 wages paid to the owner? No.
So
Can
now
it be
back to
W-2 wages paid to the owner? Yes. Does it only have to be W-2 wages to rank and file? No. Can rank and file. Anybody who gets W-2 wages, whether it's owner, whether it's the family of the owner,
So
whether
you
it's
do your part.
rank and file workers that are unrelated to them, doesn't matter. Anything that's properly reported on W-2 as W-2 wages, so long as it's filed with the Social Security Administration within 60 days of its due date.
Now he's saying
Well,
all
how?
employees.
That's not what we said earlier. That's the first time we said, oh.
This is on page 538, and then someone already mentioned this question. Wages paid by person other than the common law employer or employee's wages. Here, this is on page 538, items 6 and 7. This is where they tell us in the proposed regs, okay, if you use maybe a common paymaster, commonly owned business, separate business, or you have an employee leasing company, somebody's paying W-2 wages on those workers. If those workers are your common law employees, then you get to count those W-2 wages, even though you're not paying them directly. So, and you even got an employee leasing company. Those workers are working for your company 40 hours a week. What are they? They're your common law employees. They're not the employee leasing company's common law employees. They're yours. So the common law leasing company's, assuming they're paying the W-2s and reporting them and filing within 60 days, you get that information from them and you can count it. As I said before, what about the employee leasing company itself? Its income. Well, it can't use the W-2 wages for that limit on employees that are someone else's common law employee, even though we're doing the payroll.
No, that's
So we're
their
gonna have our
service.
employees,
Mhm.
doing the process,
Duh.
our administrative staff and all that. We can count their W-2 wages. Page 541. And on page 541, I'm looking at item 14, the bottom half of the page, and it's also this example, this point, example 1, is summarized, highlighted on page, it's on page 13 of your handout. It's in a way that's a little easier to read, so it looks easy to read, doesn't it? The same example, just set out differently, is example 1 on the bottom page 541. Let me tell you what this is dealing with. This is dealing with an S corporation. You're going to get this question, and you're going to have the situations. You're going to have to think about it and analyze and see how you're going to apply it. We're dealing with an S corporation that has an owner, who's over 415 on a joint return, or alternatively single return over 2075. So we're starting with the premise that the owner of this pass-through income coming out of the S is subject to the 50% W-2 wage limit. Let's assume there's no depreciable property, the 2.5%, we're dealing just with the W-2, and that's what we have to have. So again, we're dealing with a pass-through income from an S corporation that has, and the owner, the income is such that he or she is subject to the 50% W-2 wage limit. And then we're asking ourselves, we're looking at that S corporation, and we're looking at, before we modify the W-2 wages, let's assume we have, in this case, we have some rank and file workers we're paying W-2 wages to. We're paying some W-2 wages to the owner. But when you put them all together on these fact patterns, they're not enough to get over the 50% threshold. That is, the 50% of the W-2 wages we're paying is far less than the 20% of the QBI, which raises the next question. Well, what if we raise the W-2 wages? What if we raise them so that we got more 20 QBI went up by that, by the 50% of the raise? Is there an optimum level of W-2 wages as a percentage of QBI before deduction of W-2 wages? Is there an optimum, a sweet spot of W-2 wages where we're paying the minimum W-2 wages that will give us the maximum $199A deduction, given that 50% limit? And the answer is yes. and that percentage is 28.572%. Stated another way, now again, we're dealing with someone who's totally subject to the 50% W-2 wage limit. If we're under 315, we don't care about any of this because we don't have any W-2 wage limit. So again, we're assuming somebody's over 415 on the joint return. if we look at our QBI before any W-2 wage limit, and we paid in total W-2 wages to everybody equal to 28.572% of our QBI before W-2 wage, that is the sweet spot. That's the amount of W-2 wages. That's the minimum W-2 wages that will give you the maximum $199.80. It's subject to 50% limit. So the fact pattern we have here, we have a
They do these way too often. They used to come around so
I'm surprised that it's happening as often as it is. Like every 15 minutes.
And right there at the end, they had the survey is what we're gonna put. You know, I don't think y'all have to do it once every hour at the.
It's not even once a half hour. It's more. It's a couple times in a half hour.
Like every 15 minutes, I think.
I think so too.
Tomorrow, we
Did it refresh? Not finally.
I don't know what internet. So
for her, in this case it's Tim, we're going to increase his W-2 wages by $52,860. And we do that. And on these numbers, look what happened. When we actually compute our reduction, and we did pay him that 28.572% of 500,000.
Unrealistic number.
The QBI is 20% of 71,428. 50% of that
company
wages. Wage, that sweet spot, 71,430. They're within $2 of each other. It worked.
Instead of QBI.
The question is, how much are we saving?
Qualified business
now,
income.
when we're dealing here with Tim, note, he was paying himself $40,000 W-2 before he bumped it up. He bumped his own wages up by $52,805.
This has to be your employees.
Meaning now he's being paid $92,860.
That 28.
With regard to FICA,
572% has to be
so
W-2 wages.
Yeah, we're going to get an
wages.
Aren't we going to pay more FICA tax?
Generates a maximum.
15.3%. Now we dilute that down because we get a half
or any
unrealistic number.
So it's about a 12-point-something% net
Because
FICA tax
that
increase. So when we compute all the tax savings, and which we've done here based on his income, based on his tax rates, we're factoring in both the federal income tax savings, but the FICA tax cost by bumping up his W-2 wages by that $52,000. So the $52,000 was what we bumped him up. We show in our computations, and you just have to rely on our computations that they're right. And Don did it. And let me tell you, he's almost always right. And I should say always. The only reason I say almost is because nobody's perfect, and I'm sure he's made a mistake at some point in his life. But it's the stuff he loves. He loves this computational stuff, and he's very good at it. Anyway, back to the point. So when we did all that, this computation came up. We saved $8,457 in taxes as a result of increasing our $199.80 deduction. That's federal income tax. But we cost ourselves, that is the owner, $6,794 in additional FICA tax, with a total overall savings of only $1,663. We bumped up wages of $52,860 to the owner, but after you factored in the FICA tax cost of that on these parameters, we only saved 3.15% of that bump up, of 1,663 divided by 52,860. Not a ton. Now, there's a couple of things about it. I've had some CPAs and participants say, wait, but they did save something, didn't they? Yeah. He said, I've got clients out there that they will not pay themselves more W-2 wages, and I know it's too low, and they're just a ticking time bomb for a FICA tax audit, a payroll tax type audit. This will give me, even if they're saving 3.15%, it gives me a way to say, look, you'll be saving something, bump your wages up, and then do it without cost. In fact, they'll actually save a little bit, even in this case, in this scenario. Number two, you got more W-2 wages, increase at some point, I don't know how much, or Social Security benefits down the road. So, but the actual out-of-pocket tax savings for the year is 3.15%. But note, The increase here that we did to do this sweet spot, the before and after, that increase was all in the 15.3% FICA wage range. Now let's change it. Example 2 on page 14. Let's make it a much higher income tax rate. This is example 2 on page 14 of your handout. Page 542 of the book. Let's get Tim in a higher situation where he's already, before we do any adjustments to W-2, he's already paying himself W-2 wages that are over the FICA wage base. So every bump up we give him to increase our 199A is only costing him 2.9%, as opposed to 15.3.
It's almost, there's only one page after it.
He's making, we got $1 million of QBI before the W-2 wages. We're paying him 180 before we do anything. So he's already over the FICA wage base. We do all the computation, we take that special percentage, 28.572 times a million, and we decide that we have to pay an additional $105,720 in W-2 wages to somebody to hit the sweet spot. And who's the somebody again? It's going to be Tim. So we're going to bump him up from 180 to add $105,000 to that, and that's all within the 2.9% FICA wage. And if you look how it came out after we did the computation, when we hit the sweet spot, we had 20% of QBI after adjusting W-2 wages and deduct it from QBI, 142,856, 50% of the adjusted W-2 wages we bumped up to get 285.
So whatever QBI is, take 28.752%, and all the wages.
So then the question is, all right, we paid him another $105,720 in W-2 wages. We had to pay 2.9% extra FICA tax. But we're in the tax bracket, and of course we increase this deduction. What's the overall tax savings? And Don computes that the federal income tax savings of bumping up his wages of 105,720 on these numbers, saving federal income tax of 19,557, costing FICA tax.
I think I'm thinking more about our clients. Well, no, our clients, because we're wage heavy. Because our product is wage. I mean, it's a service.
Rate of return on tax savings.
This really has very little.
Now again, what's the difference between this and the prior? The prior was
because
we were bumping up wages to the shareholder, and the bump up wages were all subject to
QBI of $1 million.
The second scenario, we're bumping up wages,
$100,000
and their own wages bump up. There's only subject
because we
to
have no
2.9.
product to sell.
What if I'm in between? What if I'm below the 128.4 for
this percentage is
2018?
unrealistic for
What if I'm below the 128.4 before the bump up, and I'm above the FICA wage base after the bump up? Well, my return's going to be somewhere between 3.15% and 16.14. You have to run the numbers. But again, this is not to do anything magic. It just gives you an idea of kind of a ballpark view. We're going to have clients. That's too late now. For 2018, W-2 for W-2.
It is too late. Why we can't?
We got high income taxpayers, we got S corporations, and we don't have enough W-2 wages to get over that 50% threshold. They're going to be asking. We're going to be asking. Should we be bumping up the W-2 wages to be over? Is there a sweet spot? Yes. How do we compute it? Here. What kind of savings are we looking at? And this gives you a ballpark, a pretty close ballpark. And gives you an idea, is it worth doing this or not? At least gives you an initial idea of whether you want to pursue that. In some cases you are. So I hope that helps. Page 546. Now I want to hit the big topic, and I'm going to talk about it more tomorrow. And this is the SSTB. We're going to talk about it more in detail tomorrow. Why? Because the SSTB determination is made at the entity level, if you've got an entity involved. But we'll hit some just highlights. On page 546, item A, here are the tainted fields. The service fields that don't qualify: health, law, accounting, natural science, performing arts, consulting, athletics, financial services, brokerage services, investing and investment management, trading, dealing in securities, and then the catch-all potentially. Any business where the principal asset of the trader business is the reputation or skill of one or more employees or the owner. If they define that, if they describe that or define it broadly, that's going to hit almost every closely held, successful regional business, right? In most cases. And usually it's started by somebody, that somebody owns it, that somebody's well known, and many times that somebody's name is on the business. And that I mean, just be farmer, Nunley tax seminars. I mean, that's what we call them. Or if Don's really does Don Farmer, and where I go Farmer Nunley. But that's what we do. So you ought to think at a minimum, we would do that. We would do that. So how are they going to define that? What the regs do is they go through each one of these, the proposed regs, and they give you a brief description, and then they say, these are the types of taxpayers that would be included in this. These are the types that would be excluded. They don't hit everything, and there's, of course, gray in between. Tomorrow, I'm going to go through every one of these and show you what the proposed regs. I'm just going to hit a couple today. I'm going to go to the ones that have caused some concern: consulting, brokerage services, and this last one. Accounting, folks, you're in it. They even include bookkeeping service, enrolled agents. They include that specifically. So let's look at just a couple of these. Let's go to consulting and see, because those are the ones that have the bigger net, or potential for the bigger net. And I'm going to page 548. And page 548, consulting. Depending on how you define it, that could be very broad. And this is what the proposed regs say. Now let's hope the final regs can give us some more specificity. And they very likely may, because there's been a lot of comments sent to the Treasury for getting further clarification. Consulting includes any business professional advice service where you're providing professional advice and counsel to clients to assist the client in achieving goals and solving problems. That's pretty broad. And then it goes on to say any government lobbyist. They don't like government lobbyists. Every government lobbyist, local, state, or federal. If you're a lobbyist, you're a consultant. You're going to be covered by this. But what if we're not a lobbyist? The way we look at this, and they don't tell us real specifically, but the way it's been used in the other contexts of professional service corporations and so forth, where we do have some regs, typically what they're looking at is you hiring somebody who has an expertise. You hire for a specific purpose. You pay them a fee for it. And they come in and analyze your business, just your business, and they give you recommendations on what you ought to do based on their expertise. It could be expertise on advertising. It could be expertise on marketing. It could be expertise on computer stuff. It could be expertise on personnel. They give an example here on personnel. And the examples they use seem to follow that theme that we're hiring somebody who's got an expertise, and they're coming and looking at my business and coming up with a recommendation on whatever their expertise is, tailored for my business, and we pay them a fee for that. Now, computer consulting would be a classic one. When you think, you come in, you look at their software, and you look at their needs. They go into that. They give some examples, and they say, if you're dealing with someone who is selling licensed software, a business, and they're selling licensed software, the sale of the licensed software is not consulting. That's a sellable product. Well, a lot of times we have somebody come in, look, and you say, well, you need our software, and they recommend that, and you buy it. But they don't charge you separate for any kind of consulting. They just said, you need to do this. That's okay. Now, if you have that same person sell the software and then also charge separately for consulting, how to implement it, services for putting it in, all that. Those separate charges for consulting, if they're separately charged, would be consulting. But if they're just buried into the product you're selling, that's okay, according to one of the examples. So again, my view of it is, until I'm told differently, is that you're looking at an expert, you hire them for that purpose, they're looking at your specific business, they're coming back with recommendations to your business, and you're paying them a fee for it, and they're not selling the product as it is. Now, what does it not include? It doesn't include services other than advice and counsels. Well, sales, as I just mentioned, sales of products, even though they're recommending the product, and they're looking at your business saying, hey, you need this software because that's exactly what our software does, that's okay, that's a sale. Or economically services. It doesn't include provision, any group that's dealing with training or educational courses. It doesn't include any services involving training and educational courses. I hadn't seen that. Well, actually, I must have. I highlighted it, didn't I? Educational courses. It doesn't include educational. Somebody's doing educational courses. You see what I'm saying here? You see where I'm going with this? That's what it says. It doesn't include that. What are we doing?
Okay, make sure I bring one of those mice to me.
Whoops.
This is all we do. Now, the other one you'd say, okay, if you're not that, Walter, if you're not practicing law and you're not practicing accounting, your principal asset, well, I thought for sure we can call that one. Wait till we look at that. As it turns out, I think I may qualify, which is absurd. So here I am speaking to a professional group that doesn't generally qualify how to do your business. And I'm up here talking, and I qualify. What if it worked that way? And it may. Well, I've decided I don't think that's fair. And I've decided, even if I do qualify, I'm boycotting the deduction. I'm not taking it. At some point in your career, you have to stand on principle. I'm going to show them. I'm not taking it till my brothers and sisters in the CPA profession get it as well. They can take their deduction and stick it. I bet that will really upset Congress and the IRS. Well, that's what I'm thinking now. But anyway, there's some silly results in here, and that may be one of them. Page 550.
Like,
I know what you're thinking. He did like the consultant just so he could say that. Brokerage services. Now, controversy almost broke up here real quickly. Brokerage services. The real concern was, well, we knew stockbrokers, and they say that in here. They say the field of brokerage services includes a person who arranges transactions between buyer and seller with respect to securities for a commission or a fee, includes services by stockbrokers. So it seems to limit it only to stockbrokers, at least this category. It expressly says in the proposed regs does not include services provided by real estate agents. Well, they get commission, don't they? They're a broker, or real estate brokers, real estate agents, broker, or insurance agents or brokers. So they're not included. They expressly carved them out. Now, if you're an investment advisor, that is included. Some people have asked me, what about an insurance agent that sells insurance products, gets a commission? That should be okay, but they also give charge a fee for investment advice. I don't think that's out there. And can we break out the two? Maybe or maybe not. Now, so we were all relieved, at least in these industries, okay, real estate agents aren't covered. Real estate brokers aren't covered. Insurance agents, they're okay. Then we got the draft of 535. The first draft came out on December 19th, right before Christmas, and this is what it said. Brokerage services including arranging transactions between buyer and seller for a commission or fee, such as stockbrokers, real estate agents, brokers, and insurance agents. What? The initial draft of that publication that came out right before Christmas said the precise opposite of what the proposed reg said. The minute I saw that, I called them, you see that? They go, oh, now we got a conflict. And that scared us. Well, apparently they figured it out, and they re-released it on January 7th. The same publication says exactly, except it doesn't have that language. It says brokers do not include real estate, insurance agents, and brokers. So I thought I was going to come here and tell you, folks, we've got a conflict here. We got the proposed reg saying this, we got the publication saying that. We don't have that in light of this publication that came out. I read it first time yesterday, so I'm very relieved to tell you that. And that was creating some. All right, page 551. Page 551, item M. This one that says, any trade or business where the principal asset is reputation or skill of one or more employees. Now, this could be very broad depending on how they define it. And in the proposed regs, this is one they gave away. This is one very pro-taxpayer. They say, okay, what we're talking about here is only one of three situations. One of three situations. And in each one of the three, you have to be a celebrity first. They don't define a celebrity, but it's clear by what they're talking. Somebody who's nationally known or maybe internationally known. Look at the three types that they would include. Fees for celebrity endorsements, where you get a fee for endorsing a product. And a celebrity endorsement. Example of that would be Priceline. What's his name? Shatner. William Shatner. Yeah, he gets a fee for that. He gets a fee for those ads. He's endorsing it. That would be. He's a celebrity. The second kind would be fees for celebrity images. We get a fee for celebrity images, name or trademark. Example of that would be Michael Jordan, the Michael Jordan sportswear. Clearly, that would be, he's a celebrity, and clearly gets a fee for having his name affiliated. And the third is for celebrity appearances. You get a fee, you're so well known and so liked, they pay you just to show up at a golf tournament or something, which is, I'd love to have that business. Wouldn't you? You're so important and so well known, to get paid, you just have to exist. You just have to appear. You don't say anything. He said, "Hey, Walter's here. Let's give him $100,000." Wouldn't you love that? And some people, there are some people that way. Not most, not most. Now, let me step back even further. Which reminds me of another story, not to spend too much time on this, but I've always thought, and I used to, when I taught at law school at Central, I taught all the tax courses for 22 years. And I had to teach them from baby tax up through, so I went through a lot of tax. And, at some point we got to goodwill. What's goodwill? What's going concern value? And then we talk about selling a business. We talk about a non-compete and how somebody's, instrumental in the success of the business, sells the business, they have a non-compete. To do what? And I said they get paid hundreds and hundreds of thousands of dollars. To do what? Not compete. To not do something. And I always thought, I would like to be important enough that someone will pay me hundreds and hundreds of thousands not to compete. Not to do something. And I think about my work day if that's the case. I got a $750,000 check not to compete. I get up in the morning, I get in my PJs, I'm in my robe, and I come down and get a cup of coffee and read the Wall Street Journal on the couch. It's 10 in the morning, and my wife comes in and says, "Are you going to lay around again today?" I said, "What do you mean laying around?" "Well, you're not doing it. You didn't do anything yesterday either." "Can't you tell what I'm doing? I'm working myself to the bones. What are you doing? I'm not competing. I can't tell you how badly I want to get out there and compete. It's every fiber of my body wants me to go out there and start working, and I can't do it." So that's a lot of work. In fact, I'm so tired of it taking naps at about 11:30. Wouldn't that be great? I wish you had to be there at the time. But anyway, this is kind of the same way. Appearance fees. Folks, that's it. Endorsement fees by celebrities, fees for using your celebrity images, fees for appearances. They give an example of an internationally known chef, and he lends his name to a line of cookware, Chef Boyardee, whatever it is. And he's got Chef Boyardee cookware, and he gets a fee for that. Well, that's going to be included. But he also has a chain of restaurants. They're Chef Boyardee restaurants. And he works there some, and he promotes them. That's okay. That's a product. That's a business. They're generating a product. His name, is affiliated with it, but that's okay. They said that's not considered part of this. It's only these three. So there you go. Don Farmer, Walter Nunley. Now, nobody's going to come for any of those. Nobody's asking us for any of that stuff. I know. Wouldn't it be great? So that's my page 556. Yes. It's a very good question I've been asked a lot. What is the rationale, the policy, the public policy, or tax policy for carving out all this list of SSTVs? And I really do appreciate your question, because it shows at least some confidence that there's a rational reason for anything in tax. And that's a nice assumption, although we all know many times there's no real rational. I think the general reason was this 20% at some level, when they were analyzing, they decided it shouldn't be applied to income that's very service related. So they carve out W-2 wages. They carve out independent common law employees. That doesn't mean we don't have a lot of services businesses that qualify. A lot of them do. So they don't adhere to that. And then I guess somewhere along the line they said, well, there's certain professions that are so service related that even though it's a Schedule C or it's a S corporation, maybe not W-2 wages, it just is inherent that it's services. It's like a W-2 wage. That's the only thing we can come up with. And they picked out the ones, and these are the usual suspects. There's, you got the professional service corporation rules. You've got the qualified small business stock 1202 that doesn't qualify for certain professional services, so they barred against some of them. And this is the list they came up with. And there was conference. They carved out engineers and architects. You probably know that. I didn't mention that, but our engineers and architects aren't included. They're okay. Why? What do they have that we don't have? Their services. They have a highly technical degree. So do we. Many of them have advanced degrees, so do we. They have to take a very rigorous test to be certified, so do we. They provide services in an expert field, so do we. So do lawyers, so do doctors. Why did they carve them out? About lobby, probably. I mean, they were carved out at the last minute, so there's a lot of give and take there. But there's no real, to me, persuadable argument why they carved them out. Not really. He said nothing is published. Why? No, not even. Go to the Blue Book. Even that doesn't talk about it. It talks about what is and what isn't. They don't talk about why.
Better lobbyists.
That's what I was thinking.
Have why, and part of it's budget. There were a lot of trade-offs. They had to keep the whole, over a 10-year span, they had to keep the overall tax cost increasing the deficit by no more than $1 trillion. And of course, the OMB, the CBO, they budget all that out. So every time they gave something away significant, they had to have not a complete offset because they had $1 trillion to play with. But that gave, that 21% on CCAR, that was a big item. This 20% is a big item. So they chipped away at another way. Like-kind exchange, they chipped away with entertainment, they chipped away with other things. Page 557, requirements for, this is the aggregation. I just want to hit this briefly, we're almost through. Just a couple of things on aggregation to remind you. One of the requirements is if you're going to aggregate the otherwise qualify, you can only aggregate trades or businesses that have the same tax year. You can't have one fiscal year, one calendar year. You can't aggregate SSTBs with anybody. Again, I'm going to talk about SSTBs in more detail tomorrow, some other anti-abuse rules and so forth. And this gets into the 50% common control test, and I won't go into that any further. Page 557. Page 558. Page 561. Just a quick hit on the trust and estates. 1041s. Two taxpayers, two tax returns will take it. 1040s will be the most. 1041s, fiduciary income tax returns, trust and estates, they can get it as well. Now, when you're dealing with a 1041, Form 1041, trust or estate, the trust can be taxed, the beneficiaries can be taxed on the income depending on whether and to what extent you have DNI and to whether and what extent you distribute DNI out to the beneficiary. I won't go into the details, but the fundamental rules are, if you've got a 1041 trust or estate that owns an interest in a S corporation or partnership or direct ownership that's generating QBI, then the trust, the 1041, you start with the premise, it's going to get it. It's going to get the deduction. Unless it distributes, to the extent it distributes DNI for that year out to the beneficiary. Whether it's tied to the QBI or not, they allocate it based on DNI. So let's use a couple of situations. If I've got a trust or estate that retains all DNI for the year, doesn't distribute any, then whatever QBI and 20% is going to be taken is going to be taken on the 1041, assuming they own an interest. If, on the other hand, the trust distributes all of its DNI for the year, then the beneficiaries are going to get it all. The trust or estate has to disclose that on the K1, and it's all going to go to the beneficiary. What if the trust or estate distributes 50% of its DNI? Well, the trust or estate is going to get 50%, and the beneficiary is going to get 50% of each item. And they disclose the W-2 wages, they disclose the QBI, it's REIT dividends. Don't have time.
When's it over?
I don't know. What time is it now?
3:45.
Break was over at 2:45.
So it didn't tell you what time.
That part wasn't, and then how you allocate the factors and the features that give you the deduction between the beneficiary and the
Please check your phone so your husband will
send
know.
that's all I want to say.
Have it.
Sorry.
And those come tomorrow. I'll hit some other elements. Is it time for a cartoon of some sort? How many have boats, leisure boats of some sort? Fun boats and fishing boats. People love their boats. I don't have any boats. But, they always name them. You got a boat, you know, my little piece of heaven, my little getaway, whatever. Well, this is a boat. It's sinking out in the harbor, and this tugboat is trying to get it. It's almost down. But on the hull that's still out, it's got the name of the boat. No, it's a little ironic. Apparently there were some words. This is a sign that was on Crystal Methodist Church sign in Epping, South. No, that's not the. I just realized what that sounds like, but I don't mean it. I'm assuming that's a real city. Effing, South Carolina. Maybe I'm reading that wrong. That's real. They wouldn't do that. That's not what's supposed to be funny. Oh God! I've shown this up 50 times. I never even thought about that. But the sign says, "Adultery is a sin. You can't have your cake and eat it too." I thought that's kind of cute. In Effing, South Carolina. Maybe I shouldn't show that anymore. I didn't even. I don't feel bad about that. How would you like to be riding? This is a real picture. How would you like to be riding along in a plane, looking out the window, and you see this? Oh, it's your pilot. He's got a parachute on. He's just smiling away. Okay, page 563. I've already said that. Page 566. Oh, no. Okay, here we go. We're going back. This is the last time we're having to move the book. And we're on page 400. And we got 43 minutes.
43 minutes.
Miscellaneous itemized deductions. I'm going to hit some of this as quickly as I can. But miscellaneous itemized deductions, this is a big one. They've eliminated it. On page 401, the 3% phase out we've had, I think, since 1993. That's when that came in. That's gone, at least for the next 8 years. So we don't have to worry about that. That's good news. The other good news is the 2% miscellaneous itemized, we don't have to worry about that 2% phase back. That's the good news. The bad news is we don't have to worry about it at all. We don't get it. We don't get it at all. Anything that's subject to the 2% miscellaneous itemized classification under Section 67 is gone altogether. Most of you know that, but we're going to take a few minutes and see how far does that go? What's the ripple effect of that? The obvious one is any kind of investment expense, unless you're a trader. But any kind of investment expense, if it's an investment, so that's going to be gone. And the big one is unreimbursed employee business. I don't care how legitimate. Unreimbursed employee business expenses are gone. Not just 2%, they're gone altogether. And if you look on page 401 near the bottom, item A, I mean, this is obvious, but think of the kinds of expenses you could have as an employee that you used to be able to get, subject to 2% if it wasn't reimbursed. It's gone altogether. You're away from home overnight. Your hotel, your food, gone. All that's gone. Your business book, your
Why
vehicle,
is it just a limited time?
Business vehicle, you're not being reimbursed. That's all gone.
To 25.
Your union dues, all gone. Any kind of professional license you have to have as an employee to do the business, but you're not reimbursed by
ended in 2026.
Yeah, I've seen that today, and I was just wondering why.
If you're an employee, and you have a home office, you own the house. I'm an employee of my S corporation. I mean, I am the employee of my S. Well, my wife, she does a lot of it, but I'm the one that generates at least the direct revenue. And I've got a home office, and just as a quick aside, last year, I may have told you this last year in the context of qualified improvement property and the 50% 168K. I've got a qualifying home office, and I have been using my bedroom, one of the bedrooms, and it's too small. So we have a back screen porch, Orlando, with a nice backyard, and I had it made into a really nice home office, glass all around. It's got built-in wonderful bookshelves behind me, and it's got a really pretty, teak wood ceiling and everything, and it's just wonderful. It's got glass all the way around, at least 2/3 of it, or 3/4 of it. To some, if you have an untrained eye, it could look like a sunroom off the back of the house, but it's not. It's a qualified home office because I use regular on an exclusive basis, and I do, as my principal place of business. Of course, if you're an employee, what else do you have to have? It's got to be for the convenience of the employer. So there has to be some determination the employer wants or requires me to have that. So I had to have a meeting with myself. It was my house, so I said to myself, as an employee, I said, I got to have a home office. It's going to be pretty expensive. I got to have it done. And as an employer, I said, how much? And I told myself. I don't know if you're worth it, I said to me. And I said, well, I gotta have it. And as in my employer status, I said, well, I just don't know if we're gonna spend that kind of money on it. I said, well, you've gotta require me to have it or I can't take a deduction. Doesn't matter, I don't want you to do it. And I said, well, if I don't do it, if you don't let me do it, you don't reimburse me, I'm quitting. Yeah, put myself in the corner there. Because I knew that if I quit, then I wouldn't. Anyway, so I reluctantly agreed to require myself to have a home office, which I did. And I took it's qualified improvement.
That's getting funnier and funnier the further he goes.
I got 168K last year. I reimbursed myself through an accountable plan, reimbursed myself for the other 179 stuff, and so I didn't have to deal with the 2%. And when I reimbursed myself as an employee for my home office expenses, including depreciation, including 179, how do we treat it? I don't put it up, we exclude from the W-2, W-2, put it up as income. I don't even file the home office because it comes through the working condition fringe. So I still have to meet the criteria, and I've got to have all the documentation of my expenses, and I got reimbursed. But now, if I did that, the same thing. If I didn't reimburse myself, what would I get? Zero, nothing, nada, because it would be an unreimbursable business expense. Page 402, it has to be under an accountable plan. What is an accountable plan? The reimbursement in order to avoid this rule. The accountable plan is not new. It's in regulation 1.62, not 162, 62, Accountable plan has very basic. It says the employer must maintain and reimburse arrangements, an arrangement that requires the employee to substantiate the cost. Me and my S corporation, I've got to have documentation, and I do. The reimbursement arrangement says if they pay me, my employer pays any more than my documented expenses, I've got to pay back the excess. And there must be a business connection between the expense I'm incurring as an employee and the company, which of course in my case, in every case, would be business travel and so forth. Doesn't have to be in writing. Can it be just a course of conduct? There's nothing in the regulation that says it has to be in writing. It should. I mean, that would be best form. It's pretty easy, you know, as a sophisticated attorney to draft it. But if you're doing it and it's a course of conduct and you're documenting correctly, I think it should still be okay. You're doing it consistently. Page 402. Item 3 near the bottom of the page, there are itemized deductions and there are miscellaneous itemized deductions. Not all itemized deductions, obviously, are miscellaneous items. Remember, this is a list of itemized deductions that aren't miscellaneous, that aren't limited by the miscellaneous rules, are not thrown out because they're miscellaneous items. And they may have other limits, but they're miscellaneous items. Home mortgage interest, investment interest, that's not miscellaneous items. We still get, there's no limits, we know, the $750, we know investment interest can't be taken except to the extent of net investment income, but they're not miscellaneous itemized. We get state and local taxes. Those aren't miscellaneous itemized. Now we get them. Now we have a cap of $10,000 for state and local taxes, but we still get them.
I didn't know there was a cap on
losses allowed in transactions for profit when you're selling any property, that's fine. Any losses, casualty losses, that's not miscellaneous items. Now that's the good news. Bad news, they changed the rule for personal casualty losses. At least for the next 8 years, I've already mentioned you can't take them, but that's for another reason. Not because gambling losses, those aren't miscellaneous. We can only take them to the extent of gambling winnings. That's the only limit.
Why is casualty losses on there if you can't take them?
But they're not miscellaneous items. Charitable contributions, of course, not miscellaneous. Medical aren't miscellaneous. So just remember that these big boys, a lot of them, even though they may have been limited in some extent, these are not thrown out altogether because of the miscellaneous itemized characterization. Page 403. Let me go through starting on page 403, coming on down. Hit a couple of items that you may or may not think about, or may or may not have thought about, whether or not this would throw us into we'd be limited by the miscellaneous items. Item A, 4A, expenses related to rental or royalty income. Expenses to rental income, always deductible, always above the line, even if it's not a trade or business, even if it's deemed to be an investment. If it's rental or royalty generating, those expenses are fully deductible above the line. They're not subject to the miscellaneous items. Item B, I already mentioned this morning, the hobby loss rules. If you get hit by the hobby loss under Section 183, so you're deemed not to be engaged primarily for profit, then what are the rules? Under Section 183, you can deduct expenses of that hobby up to its revenues. before this law change, how did we categorize expenses that were still allowed under the hobby loss because they were not in excess of the revenue? Miscellaneous itemized. Hobby loss expenses, operating expenses after the revenues, miscellaneous itemized. What does that mean? They're gone. So the stakes are higher now for hobby classification. We've got an operation, a farm, or an antique, car repair, sale thing, collection, or whatever it is, that smacks of possibly hobby. Then, and if it is categorized that way, what's going to be the result? We have to pay tax on the revenue. We don't get any deductions for it. What if we have a good product we're selling that turns out to be a hobby? What would be an example of that? Some Amway dealers, some Mary Kay dealers. There have been cases that have come out where it was clear that the Amway franchisee was doing it primarily to take tax-deductible trips to nice places, where the conventions were, Las Vegas, whatever, and really weren't trying to make a money out of it. And they've been hit by high loss, but they sold some of their inventory. Well, we on page 403, and we're not the only ones, but I think we're right. On a second item under item B, cost of goods sold, even if you are a hobby, we think you can still deduct cost of goods sold if you're selling a product. That's not miscellaneous item. So the cost of the product, but none of the associated costs will operate. Item C, costs incurred by estates and trusts. Estates and trusts have miscellaneous itemized, the 1041, just like 1040s do, but they also have above the line. And there's section 642H, 642E, 642E, that says, section 67E, I'll get there in a minute, that says if you've got an expense of a trust or estate that's unique to a trust or estate, that is different from what an individual would incur if they weren't in a trust or estate, then we can keep those as above the line deduction. Now, investment fees generally going to be miscellaneous itemized for a trust or estate because individuals have it. But trustee commissions, executor commissions, those are unique to having an estate or a trust. Those are above the line deductions under the 1041. We have found, we've got some regs on that, certain tax prep. The preparation of a 1041, the cost of preparing a 1041, that's an above the line because the 1041 is unique to a trust or estate. The cost of preparing a 706 for an estate, that's above the line. The cost of preparing a 709, you have somebody dying, 709, and you're preparing to get tax return, that's not above the line, the regs say. What was another one? The decedent's final return, the cost of preparing that, that's deducted on the 1041. Excess deductions, right? What happens with those excess deductions? Normally, they go on the K1 of the last 1041, and they're taken by the beneficiary, correct? Like they get those excess deductions. The 1041 K1 instructions up through last year, 2017, said these excess deductions, which are in box 11 of the K1, they say in the instructions those are miscellaneous itemized. They say that excess deductions in the last year going out to beneficiaries, individual return, are miscellaneous itemized. If they're right, the IRS in those instructions, if they're right, what do we get then? Nothing for those. The AICPA, by the way, the AICPA, you're getting your money's worth from them. The AICPA has gone through this whole tax bill with fine-tooth comb, and they're picking out all kinds of inconsistencies and problems, and they think can be interpreted the wrong way, and they're sending detailed letters and commentary to Treasury and to the IRS saying you need clarification. And then they're not only saying we need clarification, they're saying this doesn't work. And this is one of those they sent a couple months ago. And they say, wait, this ought to work now. It shouldn't be miscellaneous itemized, these excess deductions, because now excess deductions have to be above the line before they're taken at all, right? with the 1041. So they ought to be above the line when they come out and not be on. The IRS could say the opposite. No, they're above the line for the trust or estate. They're not above the line for the beneficiary, and they're miscellaneous items. They're not deductible at all. They haven't come out.
Oh, now he's talking about trust returns.
But what they appear they're going to do, and this is on the draft forms of the 1041K1, the instructions to box 11, what they instruct the K1 to the beneficiary for these excess deductions, they say, treat those excess deductions on line 16 of your Schedule A. Schedule A is itemized deduction. Line 16 is other itemized deductions. It looks like they're going to give us, kind of split the baby. They're not going to give us above the line. They're not going to call them miscellaneous itemized. They're just going to give us itemized. If all of our itemized deduction is the beneficiary exceeds standard deduction, we'll get a benefit. So that looks like, not official, it's not official position they've taken, it's just in the instructions. Folks, we're going to see a lot of this. As we do prep work and we don't have an answer, the first place we're going to go is to the instructions, see what they tell us. And if there's a publication, go to that and see if it gives us some clarification. And sometimes they're just giving us stuff in here that there's no official position from the IRS. So are we going to do it if it's a pro taxpayer? It's just in the instructions? Absolutely. So it looks like we're going to get itemized. Coming on down, page 404. Item E, legal expenses related to damage awards. What about that? That can be a big one. You don't see it all the time, but when you do, that's a big one. Now, if I have legal expenses on a business transaction, Schedule C contract or business transaction, usually those attorney's fees are going to be an ordinary necessary Schedule C deduction or a business deduction that's on.
Sorry, Jackie.
But what about individual cases? When I sue somebody,
I've been here since
generally
very early.
Like that. I'm getting home.
Generally, is that damage award taxable? The general rule, yeah, it's fully taxable. There's some exceptions. One is if it's a physical personal injury. If I'm suing because of a physical personal injury, I was in a car wreck, the other person was negligent, I was hurt, I sued on that. That's going to be tax-free, unless it's punitive. To the extent you designate it punitive, it's taxable. Well, let's assume you don't. You get the dollar amounts that you want, and that's tax-free. What about the attorney's fees with that? That's not deductible because it relates to income that's not taxable. We can never deduct an expense that's directly related to tax-free income. Or if I'm a medical malpractice suit, operated and took off the wrong leg and I sued for that, that's a physical personal injury. But there are a lot of lawsuits that aren't physical. They're just emotional and other stuff. What about that? General rule on that is they're not business, they're personal, they're not physical. That's miscellaneous itemized. The attorney's fees, the little 40% they slice off of your $1 million settlement. You get $1 million settlement, you get $600,000, the attorney gets $400,000. What are you taxed on? $1 million. Wait a minute. I'll have the insurance company for the defendant just issue a $600,000 check to me and a $400,000 directly to the attorney, then I'll just pick up $600,000. Is that right? No, that's not right. The Supreme Court said that. Doesn't matter how it gets paid off. You were taxed on the entire million, and then you get, if anything, an offsetting deduction for the attorney's fees. Generally, that is miscellaneous itemized. They're gone. Now, there are some exceptions to that. That's been in the code. It's on top of page 405, attorney's fees. If your lawsuit is some kind of, based on some discriminatory lawsuit, discrimination, age discrimination, sex discrimination, race discrimination, disabilities discrimination, if you sue on one of those claims and get a settlement award, those are taxable if there's no physical aspect to it. But the attorney's fees are an above the line deduction. They just let us have that. It's in the statute. So those would still be allowed as an above the line. And that's about all I want to say about attorney's fees. On page 405, unreimbursed business expenses by a partner. Don't we have a fairly common situation over the years? We have a partnership, there's a trade or business inside, and the partner, there's an expense of the partnership, and the partnership doesn't have the money to pay for it, and we just go to whatever pocket has it, and Walter has the money in his pocket, he's the partner, he just pays that $50,000. Doesn't get reimbursed, doesn't seek reimbursement, he just pays it. How do we treat that? I mean, we could arguably treat it as a de facto capital contribution and then put it on the 1065. But more likely what we're going to do is we're going to give it to the partner on Schedule E, right? An above the line deduction, right? Can we still do that? Yeah, above the line is above the line. That's not miscellaneous item. Now just remember, and there's case law on this, we got a case a couple of years ago, I mentioned it in most seminars. When you're doing that, you have a partner who's paying off and on or maybe habitually expenses of the partnership and then not getting reimbursed and deducted on the Schedule E. There's case law that says where the IRS comes in and says, look, yeah, you can take a deduction if the partner paid it, provided that the partner didn't have an express or implied right to get reimbursement. If we find that partner had a right to get reimbursement and didn't seek it, then nobody gets no deduction, neither the partnership or the partner. Now, we typically say have some kind of memo or something that says whenever a partner is incurring a partnership expense and not being reimbursed, that something that concedes between the parties that they're not going to be reimbursed. There is also case law that says even if you don't have a written agreement, if there's a course of conduct over the years, the partner pays and never gets reimbursed, that can be as well. But that's a different issue. That's whether you can deduct it at all. But once you get over that threshold, then that would be an above the line deduction. Independent contractor, page 405. I've already mentioned this briefly. Item I, just want to remind you. If you're an independent contractor, of course, all your business expenses are Schedule C. Schedule F. They're fine. But if you get recharacterized, you, the worker, as a common law employee, then dominoes start falling now. One domino. Usually when you think of recharacterized workers, you think of the employer, don't you? You know, they're hiring truck drivers, and they're treating them as independent contractors. And the IRS says the truck drivers are employees, and they come and hit the employer. And they hit you for not paying payroll tax, not filing payroll tax returns, not making payroll tax deposits. That's where they hit the employer. And then historically, they haven't normally looked so much at all, and sometimes not at all, at the worker. They're starting to do that more. There's going to be more reason now, particularly for savvy independent contractors. They say they're independent contractors, Schedule C, particularly consultant types, professional types. If they can come in and reclassify you as a common law employee, what happens? Well, number one, you lose your 20% deduction for your Schedule C. You lose all of your business deductions because they become miscellaneous itemized de facto. And finally, we've already, as I said earlier, we've got a case on this a couple of years ago. You lose your retirement plan contributions. In this case, it was the Rosenfeld case, and it was a consultant, and he was reclassified, and he lost his contribution to himself. So it's a big issue. We got to be aware of that. Page 406, near the top of the bottom of the page. I'm sorry, page 405 at the bottom. Statutory employees deduct business expenses on Schedule C. Someone asked about that. We hear opine that if you're a statutory employee and you meet the criteria, it's one of 4 categories. Certain commissioned truck drivers, top of page 406. Certain insurance salesmen, certain home workers, certain traveling salespersons. And you are an independent contractor, which you're supposed to be before you're designated a statutory employee. That box on the W-2. But if you meet all those criteria, yeah, your income, your expenses are not miscellaneous itemized, they're above the line. And you should get the 20% on that, because that's not W-2 income. That's not employee. That's independent contractor income. And Publication 535 says that, the one that just came out. What about ministers? Well, the same rules as anybody else. They're a common law employee, and most of them are, and they're incurring expenses for their flock, or their whatever, that would normally be business type expenses, and they're not reimbursed, they lose it. They need to be reimbursed just like anybody else. Now, what about for SE tax? Don't ministers, even though they're W-2 and they're common law employees, don't they pay SE tax? And they have to have SE income? Then the question is, okay, these expenses they weren't reimbursed for because unreimbursed employee business expense, they can't deduct them for regular tax, but can they deduct it from for their SE tax computation? And we think they can, because if you look on page 406, near the right above item J, ministers who are employees apparently still deduct unreimbursed employee business expenses for SE income. And the reason for that is there's a revenue rule. We cited back in 80 that says the miscellaneous itemized designation doesn't apply to a minister for purposes of SE tax. It does apply for every other purpose. So we think that should still be controlled. Item J, what about I'm self-employed? I pay health insurance for me, my spouse, and my kids. Don't I take an above-the-line deduction on the 1040? Can I still do that? Yes. Is that miscellaneous? No, that's not miscellaneous. That's above the line. It should be fine. Tax return prep cost, item K. Well, for Schedule C, F, and E, and I've been above the line in the past, still is. 1040. Page 407. Item J, investment advisory fees, they're not going to be deductible anymore. RAT fees, not deductible anymore, which raises the question. I've had this half a dozen times in the last 2 months traveling. What if I've got my investment advisor with Wells Fargo. he gets, whatever percentage of the value on a quarterly basis of the fund he's in control of. It's a rap fee. It's not based on transactions, it's based on value. What about that? Well, that's not deductible. Well, what if we spend the year, we take that amount, because that's rap fee, and we capitalize it into the transaction. We look at all the transactions and we kind of bear it into the cost, and therefore it offsets the gain or increases the loss, and in fact we get a deduction that way. That's been asked in the past to try to avoid the 2%. And we cite to you on page 407, item L, there's a Chief Counsel Advisory, first right at the beginning of that statement. Chief Counsel Advisory 2007, blah, 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 blah. And the Chief Counsel's office was asked that very question. They said you can't do that. You can't capitalize. Now, if you sell as a broker and you can charge a commission, that's okay. That reduces the gain or increases the loss. That's fine. But as a generic rap fee that's based on a percentage of the value, and you go back and capitalize it into the transactions, the Chief Counsel, that's a pretty high level of thing. Says you can't do that. And that's all I want to say about that, unless you have a question. Page 409. Page 413. Moving expenses. Page 414. Boy, he's running like a bat out of Hades. Moving expenses are gone the next 8 years. They're just gone. Everything that was 35-mile rule, all the rest of it, they're just gone. They were above the line, they're gone. What about reimbursed by employers? That's taxable. So moving expenses, that's terribly controversial, particularly for big businesses that have moving employees. So that's gone. And reimbursing employees, there are some exceptions for members of the armed forces. But other than that, it's gone. You reimburse what would have been qualified employee moving expenses by the employer starting in 2000. Page 429. Yes. Sure. Right. Well, the question is, it's kind of a takeoff or a variation of what I mentioned earlier. These rap fees are, it's a percentage of the balance. So do I think the question is that some of the brokerage firms are going to start trying to capitalize and allocate that rap fee to the transactions and maybe disguise it in there. I wouldn't be surprised if they try to. All I can say is at least an obvious frontal attempt to do that, according to the Chief Counsel's office, isn't going to work. So unless they, somehow they get in effect a percentage of the balance, but they somehow tie it to the transactions. The human mind, in particular those investment people, they can come up with a lot of different things. But I don't think anything that's flagrant is going to work in most cases. Page 429, charitable contributions. Not much change there. Well, there's one. Okay. One, the limit actually improved. The 50% threshold of the contribution base for cash has been increased to 60%. Now, there's a glitch in the statute. It appears, and everybody seems to agree with that. And that is, the 60% threshold for cash contributions instead of 50 will not kick in if you make any non-cash contributions. It wasn't intended. The way the statute is drafted, if you make even $1 of non-cash contribution, marketable securities, then it would throw your cash contribution limit back to 50% where it was before. The technical corrections bill would fix that. So it is clear that they understand that that's an issue. But how the software is going to deal with it, I don't know. But nonetheless, there hasn't been any administrative relief by the IRS yet on that. And on page 429, yes. Yes, okay. You have a carry forward from a prior year, did you get the 60%? Let's assume it's all cash. You see me pausing, don't you? The minute I pause, I don't know the answer. If I know the answer, I'll fire it right out. usually when you don't know the answer, and you can use this as well, I've said this for years, but you think you should know, the question is, do you have a carryover from a pre-18 year, do you get the 60%? And I should know that, and I don't, off the top of my head afterwards, because I hadn't looked at it. But usually, what you do to cover yourself, to pretend like you know, you say, as I understand it, as I understand it, and I give you some crap answer, and I don't know if I'm right or wrong. But you're always right if you say, as I understand it, because if you're right, you're right. If you're wrong, you didn't understand it right. I told you as I understood. So I can't even say that. I don't know. I just don't know, sorry. Page, and that's all recorded. Page 429, I'm kidding, of course. Page, I should have acted like I couldn't hear you, right? Yeah. Page 429, item 4, planning alert, just this charitable contribution. In light of these changes, doesn't the rule that we have, and this is not an expiring provision anymore. It's permanent in the sense it doesn't have an expiration. The penalty for someone who's at least 70 and a half, and a beneficiary of an inherited IRA can do this as well if they're 70 and a half. They can transfer up to $100,000 directly from their IRA to a charity, count toward the minimum required distribution, right? And be excluded from their income. Is that still used? How many have used this or had clients? They're used all the time. Does that even come a little bit for particularly middle incomes, lower middle income taxpayers that are older that are using the higher standard deduction? Doesn't this even become more valuable? Isn't it almost a no-brainer? If I'm going to get $8,000 to the church, and I'm going to get $8,000 in minimum required distributions anyway, and I'm going to do $8,000, and it's a no-brainer to do it from the IRA because it's an all-win, no-loss. Yeah, so it becomes even better in that sense because of the standard deduction. Now, I just learned this. I don't know North Carolina taxes. I don't do a North Carolina income tax return for myself. I'm in Florida. In Florida, I don't have an income tax. I'm shocked. I was shocked when I moved down there. See, my whole professional life had been Raleigh, North Carolina. 35 years. North Carolina income tax. North Carolina income tax. I moved down there full time in 2012, I think. 13 was my first. And I did my federal, got to do the state. There was no state. And I went back and looked to see what I paid the last year in North Carolina. And then I didn't pay it this year. It's just neat. I'm paying a state income tax. It's really kind of neat. I'm just rubbing it in is what I'm doing right now. But anyway, so I don't keep up with North Carolina much, but I do know if I got it right. I just saw it recently. I looked at some of the big things. And now North Carolina, if you want to transfer.
I didn't mean to hit send, but I did.
Is that right? But you get an offsetting charitable contribution, correct? If you would get it for federal purposes. Well, how do you get it for federal purposes? If it's $250 or more, you got to get that confirmation, don't you? Well, even for federal purposes, they say for this to qualify for the exclusion, there's a notice 7-1 says for it to qualify for the exclusion, several things, direct transfer and so forth. But you've got to get back if it's $250 or more, you've got to get back the magic language written confirmation as though it was a charitable contribution to get the exclusion. So if you don't get that on a timely file, by the time you do a timely file return, you're not going to get the exclusion. You're not going to get the deduction either federal because you didn't get that. So you're going to have to get that for all purposes. For North Carolina to take the offsetting charitable contribution, because it says what I read, it has to qualify for what you would get for a charitable contribution for federal if it wasn't a charitable contribution deduction. And you've got to get the confirmation to exclude it for federal purposes. There's no big deal. Good. Page 431, page 453. Page 453, top of the page, deduction for state and local taxes. This has not been controversial at all. Oh, I'm telling you, there's some states that hate this. Where are they? Well, they're the high income tax states. Northeast, New Jersey, New York, Connecticut, Maryland. I speak in Maryland, I speak in Connecticut. Boy, they hate this. California, and Florida, we don't care at all. We don't have any income. Oh, did I say that before? And you say, well, you got high sales tax. Well, it's not much higher than North Carolina. High property tax, not much higher than North Carolina. We got crappy schools, but that's the price you pay. Actually, I think we got fine schools. I'm not saying North Carolina taxes too much. They don't. I'm sure I probably end up paying the same taxes. Just the fact I don't have to do an income tax. It's kind of neat. That's why. You'll be stunned by this. This is why some people in New York moved to Florida. I can't believe it. Page 453. So what's the limit? The limit is you can deduct, as you know, no more than $10,000, $5,000 married, filing separate, of your state and local taxes, property taxes, sales taxes, income taxes. Now that doesn't apply to property tax, sales tax that imposed on the business, and there's sales tax on the product, or a property tax that's imposed on a business that has business property tax. That's fully deductible. Or if you have a property tax that's imposed on an investment, when you have a property tax imposed on an investment, the question we've been getting is real estate, investment real estate. You get investment real estate, you pay property tax on that, and you're really holding for investment. Can you fully deduct that? Apparently you can. And if you look on the draft, now I think we have the final Schedule A, I think it's line 6 under property taxes. It gives you, it limits it, state and local even back to 10,000. But the last line in there says other taxes that has no limit. I think it's line 6.
On some of those like that, with the real estate.
It's an itemized deduction, but fully
instead of
property tax on
just let them go, like on these that have all these multiple properties.
There is a
you just need to track them so when you sell them. I think
North Carolina. I got this right.
Like top level clients.
Again, every state I go to, I don't know a lot about. See if I got this right. We came with the rules over. I think the rules are, and see if my research is right. For 2018, can a North Carolina taxpayer itemize if they don't itemize the federal tax? Yeah. It doesn't matter in 2018. And there's some special report for 2018 for sure, regardless of what you do for federal. You can use standard or itemized for state, right? Point number 2, if you do itemize, what's the most you can deduct property taxes, property taxes and qualified residence interest? Now, what's in the aggregate total? 20,000? 20,000 most you can deduct. If you could otherwise deduct it for federal purposes, you can up to 20,000. With regard to North Carolina,
we should be fine. The problem is how much they're going to watch.
You're limited to $10,000 on property tax, property and state local taxes. The only tax that we're dealing with for federal is property tax, but you can also deduct for North Carolina. So, to the extent I did $20,000 in total, home mortgage interest and property tax, correct? Now, my property tax I can only deduct for North Carolina to the extent I could have deducted it for federal. What's the most I can deduct for federal property tax? The most, $10,000. Well, what if I have state income tax and property tax of $18,000 on the federal? I can only deduct $10,000 in total. Which is deemed to be deducted for federal purposes? For North Carolina, which do I want deemed to be deducted first? Property. I want to assume that when I pay state and local income tax and property tax, and I hope I'm getting this right, for federal, that for North Carolina purposes, the $10,000 I'm limited to, I'm hoping that the first $10,000 is eaten up by my property tax. Let's assume I'm paying at least $10,000 of property tax. Because if that's the case, then I would have been able to deduct $10,000 property tax for federal, which allows me to deduct up to $10,000 for North Carolina, correct? Has North Carolina ruled on that? Something came out, Sharon Bryson, on that chat room,
like 3 days
Revenue,
ago.
They've said, apparently the Department of Revenue, somewhere she got this, that so long as you paid at least $10,000 of property tax as a North Carolina resident, that $10,000 is deemed to go against the dollar for dollar to the first $10,000 of your state and local taxes on the federal level. So to say it another way, you got the overall cap of $20,000, but your property taxes, you can deduct dollar for dollar into that $20,000, dollar for dollar, every dollar of your property tax up to $10,000. Even if you paid state and local income tax on the federal as well, and you cap them together at 10. Does that make sense? Yeah. Now, if you pay $12,000 in property tax in North Carolina, you can't deduct more than 10, right? Because you can only deduct the amount you can deduct for federal, and you're deemed to have deducted the first property taxes. You're deemed to first state and local taxes. You're deemed to have deducted for federal or property, which is up to 10. So again, as I'm reading this correctly, does that confirm what other people know? Does anybody disagree with that? You can deduct the first $10,000 as an itemized deduction. Where if you itemize or take standard for federal, you can deduct the first. If you itemize for North Carolina, doesn't matter what you did for federal, you could have deducted up to $10,000 of property tax or federal, even if you took the standard.
Make sure that flows right.
So you get the first $10,000 property tax deductible within that 20 for North Carolina.
Because that's just something the radio station.
Page 455, item 5, and I don't think this is going to be an issue in North Carolina. It's a big issue in some states. There are a lot of the states, some of the states, particularly in the Northeast and California, when they got this limitation on state and local taxes, they decided to try to do a workaround. And the way they were going to do a workaround is instead of state-established charitable organizations, that the money would be used to fund state operations. And the way you would do it is, if you made a contribution to this state-sponsored fund, you get a charitable contribution deduction on your federal, and get a dollar-for-dollar credit on your state income tax. And there's no limit on charitable contributions. You've heard about that. I don't remember that either.
I don't remember that ever. But it's kind of cool.
When you pro quo for your quid, it knocks out the whole deduction because you didn't have donated intent. So how could it possibly work? And that's an effect that the IRS has said in their proposed regs. They said if you give it, but they didn't limit it to just the government-sponsored charities. It was any charity that you give a contribution back and you get back a state credit in response to that, unless that state credit is 15% or less of the amount of the contribution, that's a de minimis rule. We'll ignore it. If it's 15% or less, you put in $100, you get $15 or less of a credit back. That's okay. You get $100. If it's over 15% the credit, then you have to reduce the charitable contribution for federal purposes by the dollar amount of the credit. Now, does North Carolina have it? You certainly didn't say that the state ones. South Carolina has one that's hit by this. Conservation easements, and Virginia, and Colorado, where we speak. In South Carolina, you make a conservation easement, a qualified conservation easement, South Carolina approved by the state and so forth. Just conservation easement, you get like 45% credit up to a dollar cap on that conservation easement. It's going to hit it. There's 45% is more than 15%. That dollar amount. Virginia has the same thing, but you don't have that in North Carolina, do we? I say we, collectively, royal we. There's no conservation easement credit for contributions in North Carolina. Is there any other organization you can contribute to in North Carolina and get a North Carolina income tax credit? I don't think so. Then this isn't going to. That's good. That's good. Well, folks, that's all I want to say. I want to thank you for coming. I hope to see you next year. I will see some of you tomorrow. Have a great new year. And what do we have there? CPE, yeah. They take that out. CPE out, yeah. They take care of that in the front. Thank you for coming. You don't have to do that, but thanks.